Securities are financial instruments that hold monetary value and can be bought, sold, or traded in financial markets. They represent ownership, debt, or investment contracts and are a crucial part of the global economy. Types of securities. Equity securities, stocks, represent ownership in a company. Shareholders may receive dividends and benefit from stock price increases. Example: buying shares of Apple or Tesla makes you a partial owner of the company. Debt securities, bonds, represent a loan made to a company or government. The borrower repays the principal with interest over time. Example: buying a U.S. Treasury bond means lending money to the government in exchange for interest payments. Derivative securities, contracts that derive value from an underlying asset, stocks, commodities, currencies. Common types include options and futures contracts used for speculation or risk management. Example: a futures contract on oil allows traders to buy or sell oil at a fixed price in the future. Hybrid securities, combine features of both stocks and bonds. Examples include convertible bonds, which can turn into stock, and preferred shares, which offer fixed dividends but no voting rights. Why are securities important? Raise capital for businesses and governments. Companies issue stocks and bonds to raise funds for growth. Governments issue bonds to finance infrastructure projects. Investment opportunities for individuals. Investors buy securities to earn dividends, interest, or capital gains. Securities allow people to build wealth over time. Liquidity in financial markets. Securities can be easily bought and sold in stock and bond markets, allowing investors to access cash when needed. Diversification and risk management. Investors reduce risk by holding a mix of stocks, bonds, and derivatives. Some securities, like bonds, offer steady income, while stocks provide growth potential. How are securities regulated? Securities markets are regulated to prevent fraud and protect investors. In the United States, the Securities and Exchange Commission, SEC, oversees stock and bond markets. Other countries have similar regulators, like the Financial Conduct Authority, FCA, in the UK. Regulations ensure transparency, fair trading, and financial stability. Example of securities in action. Imagine a company needs $10 million to expand. It can issue stocks, selling shares of ownership to investors. It can issue bonds, borrowing money, and repaying investors with interest. Investors choose between stocks, higher risk, potential for big returns, or bonds, lower risk, steady returns. This system keeps businesses funded and financial markets running smoothly. Quick recap. What are securities? Financial instruments that represent ownership, debt, or contracts. Types: stocks, equity, bonds, debt, derivatives, and hybrids. Why are they important? Help companies raise funds, offer investment opportunities, and provide liquidity. How are they regulated? Government agencies like the SEC ensure fair and safe trading. Understanding securities helps investors and businesses navigate financial markets, manage risk, and grow wealth efficiently.